You remember the narrative. We all do. Go back to late 2022, early 2023. The Federal Reserve started hiking interest rates to the moon. The pundits, the YouTube gurus, the headlines, they all promised us one thing. They promised a great reset. They told us that when rates went up, home prices had to come down. It was basic economics, right? The law of gravity. What goes up must come down. They told you to wait. They said, don't buy at the peak, keep your powder dry, wait for the crash, then scoop up your dream home for pennies on the dollar. Well, it is 2026. Look around. Where's the crash? Where is the reset? If you listened to that advice, if you sat on the sidelines waiting for 2019 prices to return, you aren't just frustrated, you are likely poorer, because the Great Reset never happened. Instead, we got something much more painful. We got the Great Freeze. Today, we are going to have a very honest, very uncomfortable conversation about the American housing market. We aren't going to talk about what should have happened. We're going to talk about what is happening. We need to look at why the math of homeownership has fundamentally broken for the middle class, why your equity might be trapped, and why the old rules of buying and selling real estate are currently dangerous to your wealth. Let's start with the elephant in the room, the inventory crisis. Basic economic theory says that high interest rates crush demand, and they did. Demand dropped, but what the textbooks didn't account for was that supply would drop even harder. We have to talk about the golden handcuffs. This is the macro concept that is ruining your microeconomics. Back in 2020 and 2021, millions of Americans refinanced their homes. If you were watching this, you probably have a mortgage rate sitting somewhere around 3%, maybe even 2.75%. That mortgage isn't just a loan anymore. It is a financial asset. It is an asset that pays you to keep it. Here's the kitchen table reality of that. Let's say you live in a decent 4-bedroom house in the suburbs. You bought it 10 years ago. Your mortgage payment is $1,800 a month. But now the kids are off to college, the house feels too big. You want to downsize. You want to sell that big house and buy a nice, manageable 2-bedroom condo closer to the city. You go to the bank and you run the numbers. That smaller condo costs $450,000. But the interest rate today isn't 3%, it's hovering near 7%. You run the math and you realize something terrifying. The monthly payment on the smaller condo, after you put 20% down, is $3,200 a month. Think about that. You are trading a 4-bedroom house for a 2-bedroom condo, and you are paying $1,400 more per month for the privilege. That is the lock-in effect. That is why there are no for sale signs in your neighborhood. Nobody in their right mind is going to voluntarily double their housing cost to live in a smaller box. So nobody sells. And because nobody sells, inventory stays at historic lows. And because inventory is low, prices don't crash. They just sit there, staring you in the face, defying gravity. This is the stagnation. This is the freeze. The move-up buyer is dead, the downsizing boomer is stuck, and the first-time home buyer, they are completely locked out. But let's peel back another layer, because even if you can afford the mortgage, there is a silent killer of wealth that nobody puts on the Zillow listing. We need to talk about the unbundled cost of ownership. For 30 years, when we talked about the cost of a home, we focused on the principal and interest. That was the big number. But in 2026, the components of your monthly payment, the taxes and insurance, are eating people alive. Look at what is happening in Florida. Look at California. Look at Texas. We've seen insurance premiums double, sometimes triple in the span of 3 years. This isn't just about hurricanes or wildfires. This is about reinsurance markets, a global financial layer that insures the insurance companies. Their costs went up, so your costs went up. I was reading a forum post the other day from a guy in Tampa. He paid off his house, zero mortgage. He thought he was free. He thought he had reached the finish line. Then he opened his escrow letter. His homeowner's insurance premium jumped to $6,000 a year. His property taxes adjusted to the new inflated value of his home, adding another $5,000. He's paying over $900 a month just to exist in a house he already owns. That is the kitchen table reality. You have to work 40, maybe 50 hours a month just to pay the taxes and insurance on a paid-off asset. That isn't ownership. That is renting from the county and the insurance carrier. And unlike a mortgage, those costs never get paid off. They only go up. So when realtors tell you, marry the house, date the rate, they are leaving out the part where you also have to marry the tax assessor and the insurance adjuster, and they are high-maintenance spouses. Now, let's look at the two-sided argument, because you will still hear people say, but renting is throwing money away. You're paying your landlord's mortgage. Is that true in 2026? Let's look at the cold hard arithmetic. In many major U.S. cities right now, Austin, Phoenix, Seattle, the cost to rent a luxury apartment is significantly lower than the cost to buy a starter home. I'm talking about a $1,000 to $1,500 monthly difference in favor of renting. If you rent, you are throwing money away, sure. But if you buy, you are throwing money away on mortgage interest, property taxes, insurance, and maintenance. In the first 5 years of a 7% mortgage, almost 90% of your payment is going to interest. You aren't building equity, you are paying the bank rent. So the question becomes, where does your wealth grow faster? Does it grow faster trapped in the drywall of a house that appreciates at 3% a year? Or does it grow faster if you rent, save that extra $1,500 a month, and invest it in a diversified portfolio compounding at 7 or 8%? This is a mindset shift that is very hard for Americans to accept. We have been programmed since birth to believe that the house is the ultimate piggy bank. But when the cost of capital, interest rates, is this high, the piggy bank has a hole in the bottom. Let's talk about the builder bailout. You might notice that the only inventory available right now is new construction. You drive past these new developments, and they are offering rate buy-downs. They say, buy with us, and we will give you a 5% rate for the first year. Be very careful here. Read the fine print. This is what we call a teaser rate. It's a temporary subsidy. The builder is taking a cut of their profit to lower your rate for 12 or 24 months. But what happens in year 3? The rate resets. Your payment jumps up. They are betting, and you are betting, that rates will come down by then so you can refinance. But what if they don't? What if inflation stays sticky? What if the correction we're waiting for is actually a decade of higher rates? Then you're stuck with a payment you can't afford in a house that might be losing value because the builder just slashed prices on the next phase of the development to keep sales moving. It's a dangerous game of musical chairs, and you don't want to be the one left standing without a seat when the music stops. So what does this mean for you? What is the actionable reality? First, stop waiting for 2019 to come back. It's gone. That price point, that affordability, was a historical anomaly fueled by cheap money. It is in the rearview mirror. Second, if you are a homeowner with a 3% rate, you need to understand that your move-up dream might be on hold. And that is okay. The most powerful financial move you can make right now is to love the house you are in. Renovate it, fix the kitchen, add a deck. Because the transaction costs of moving, the agent fees, the closing costs, and the higher rate will destroy more wealth than you realize. Third, if you are a first-time buyer, you need to ignore the peer pressure. Do not buy a house because your parents told you it's what responsible adults do. Do not buy a house because you have FOMO, fear of missing out. Buy a house only if the PITI, principal, interest, taxes, and insurance, is comfortably within 28% of your gross income. If the math doesn't work, keep renting. There's no shame in renting. There is only shame in being house poor, unable to afford a vacation or a nice dinner because your water heater broke and you have zero liquidity. The Great Reset was a myth. What we have now is a standoff. Sellers won't sell, buyers can't buy, and the prices are stuck in the stratosphere. This is a time for defense, not offense. It is a time to preserve your liquidity. It is a time to keep your debt low. It is a time to look at housing as shelter, a cost of living, rather than a get-rich-quick scheme. The days of buying a house and flipping it for a $100,000 profit 2 years later are over. We are back to the boring, slow grind of traditional home ownership. And honestly, that might be a good thing. It forces us to be disciplined. It forces us to look at the numbers, not the emotions. I know this isn't the exciting news you wanted. I know I wanted me to tell you that the bubble is popping next Tuesday and you can buy a mansion for peanuts. But my job isn't to sell you a fantasy. My job is to make sure you don't walk into a financial bear trap because you were looking at the wrong charts. The market will eventually thaw. Life happens. People get divorced. People pass away. People move for jobs. Inventory will slowly creep back. But until then, protect your cash flow. Keep your powder dry, not for a crash, but for the right opportunity that makes mathematical sense for your life. I'm just a guy reading the charts and connecting the dots, not a financial advisor. So do your own homework, run your own budget, and don't let the headlines make your financial decisions for you. Stay safe out there.